Welcome back to Cheryll Trades LEAPS. Most traders buy options at the worst possible time, right after a stock has already run up. Then the stock pulls back, and their options lose value before the trend continues. But there is one simple indicator that can dramatically improve your timing. It's called the Exponential Moving Average, or EMA, and it helps traders identify where trends may continue. Today, I'm going to show you how I use EMA to find better LEAPS entry points. Before we talk about the Exponential Moving Average, we need to understand what a moving average actually is. Moving averages are a fundamental concept in technical analysis, helping us make sense of market trends and data. Imagine tracking the price of a stock, Bitcoin, or even the temperature every day. Price trends help us understand where things are headed, but raw data can be noisy. A moving average smooths out this noise. The simple moving average, or SMA, is calculated by taking the last 10 days of prices, adding them together, and dividing by 10. This gives us today's average price. The moving average updates by removing the oldest day, adding the newest price, and recalculating. This constant update is why it's called a moving average. In a simple moving average, every day is treated equally. But markets move quickly, and recent prices matter more. SMA can react too slowly to important changes. Recent prices matter more than older ones. While SMA treats every day equally, the Exponential Moving Average, or EMA, gives more weight to recent prices, spotting trends faster. Think of SMA as everyone's opinion counting equally, while EMA gives a louder voice to those who checked the market today. Recent opinions matter more. Because recent prices get more weight, the EMA reacts faster when trends change, making it better for active traders watching fast-moving markets. 1. Why traders use EMA? Since the EMA responds more quickly to price changes, it helps traders see when momentum is shifting. If price suddenly starts rising, the EMA will turn upward sooner. If price starts falling, the EMA will adjust downward more quickly. That makes the EMA extremely useful for identifying trend direction and potential support levels. 2. The 3 most important EMAs. While traders use many different moving averages, I focus on 3. A. The 20 EMA, 20-day period. The 20 EMA represents short-term momentum. In strong trends, price often rides above the 20 EMA, and small pullbacks may stop here before continuing higher. B. The 50 EMA, 50-day period. The 50 EMA is one of the most important levels in the market. Many institutions, hedge funds, and professional traders watch this level. In strong uptrends, stocks frequently pull back toward the 50 EMA before continuing higher. Because of this, the 50 EMA often acts as institutional support. C. The 200 EMA, 200-day period. The 200 EMA represents the long-term trend. When price is above the 200 EMA, markets are generally considered to be in a long-term bullish environment. When price falls below the 200 EMA, the broader trend can turn more bearish. 3. Why EMA matters for LEAPS. Traders' LEAPS are long-dated options designed to capture major trends. But timing your entry still matters. If you buy LEAPS after a big rally, the stock may pull back first, which can cause the option to lose value before the trend continues. EMA helps solve this problem by showing where pullbacks may find support. Instead of chasing price higher, traders can wait for the market to come back to them. 4. MA pullback strategy. One simple approach is called the EMA pullback entry. Here's how it works. First, identify a stock that is already in a clear uptrend. Second, wait for price to pull back toward the 20 EMA or the 50 EMA. Third, watch for signs that buyers are stepping back in. When price begins to bounce from that level, the trend may continue. For LEAPS traders, these pullbacks can provide better entry points than chasing breakouts. 5. Example. Using the chart. Let's look at this chart. First, we see an initial breakout where the stock begins moving higher. After the breakout, the stock pulls back. This pullback moves down toward the 50 EMA, which is often watched by institutional investors. Then we see something important happen. Price touches the 50 EMA and begins to bounce. This bounce suggests that buyers are stepping in. This area becomes a potential LEAPS entry zone. After that bounce, the stock resumes its trend and moves into the next leg higher. 6. The key idea. The biggest mistake many traders make is buying when the market looks exciting. But professional investors often do the opposite. They wait patiently for pullbacks toward key levels where support is likely to appear. EMA helps reveal those areas. 7. Final thoughts. The exponential moving average is not a magic indicator, but it is one of the simplest tools for understanding trend direction and timing entries. For LEAPS traders, combining strong companies with smart entry timing can significantly improve risk and reward. Thank you for watching and see you in the next video.